What's going on? Steve here with IBC Global. I hope your day is off to a great start. In an earlier video, we discussed how people use their whole life insurance policies as a bank or like a personal line of credit. In today's video, we are going to look at an actual policy, or I should say an individual that has several whole life insurance policies. Why he started whole life insurance was because of this. He was attracted to the idea of funding whole life insurance policies with a lot of cash. He was interested in the cash value and wanted to use a policy like his own bank. He wanted to be able to use his policy instead of going to a bank and getting a loan from them. He liked the idea of doing things on his own. So what we'll look at specifically are his 4 policies, the combined values, and what it looks like if he takes out some very large policy loans, repays them, and how does he use it like his own bank. So to begin, what I will share very quickly is if you are interested in a whole life insurance policy, that is what our company does. What I'll say is whenever someone reaches out to us, what our company, IBC Global, does is set up policies for maximum cash value and really make sure that everything is set up right from the get-go, meaning choosing the right company, choosing the right product, and then providing ongoing support and guidance throughout the life of the policy. As long as you have a policy, we continue to work with you. And you can find us on our website, ibcglobalinc.com. So let's get on into it and have some fun, shall we? So we've got an individual who I've known for a long time now, several years. When I met him, he was in his mid-40s and he has 4 whole life insurance policies. This is a combination of policies on him and his wife. He has policies on his 2 children as well, but we're only going to focus on the policies for him and his wife because those are his larger policies. So he's funded his policies aggressively over the years, and he's getting close to about $2 million in total cash value. And his policies are all between 2 and 5 years old. So he has not had them for a very long period of time. And again, what he has almost in cash value is $2 million, a little bit less than that. What he plans on still funding his policies with, meaning what he wants to pay, is just about another $1 million. And that'll be over the next 2 years. He's actually in a position where he's come into a lot of cash. His original plan was to fund some of these policies for a very long period of time, but he said, hey, I might actually retire early. I've got the means to aggressively fund these policies up front. What's it look like if I just fund them for 2 more years and then stop altogether, which you can do with the policy? So that has more so to do with the funding and maximizing the cash value of a policy, making sure we don't have to pay into it for a long time, which is important. But what we're going to look at here is, again, how we can use the policy. So when I say retire in 2 years, keep in mind, we connected when he was in his mid-40s. So when he says retire, that means retiring from his present employment where he currently works, and he likely will do something else. I want to say he may, but just knowing him, he's always going 100 miles per hour. He'll probably do something else. So what we're going to look at here is, what if he decides to start his own business and he takes loans against his policy, or policies, I should say, just about $370K per year for 5 years. So he's borrowing heavily and then begins to repay those. That's what we're going to look at, which he doesn't have to repay. For what you're about to look at, we're going to look at repaying the loans, but we modeled what it would look like if he takes out those loans and never pays anything back, which is important to do really just to stress test the policy. When we're going to take aggressive loans against our life insurance policy, what we want to make sure of is that we don't overloan, meaning take out so much money that the interest due on the loan exceeds the earnings on the policy. That could put us at a risk of a policy lapse, which if there's a gain on that policy and loans can actually count toward the gains on our policy, that could result in a big tax bill down the road. We've got other videos that you can check out up here that provide information on that, but it's important to avoid that type of situation. And how you can avoid it is when you're looking at loans, I would ask to see illustrations to see what things look like if you don't repay it. Even if you think you can easily repay it, what does it look like if you don't repay it? This way you know what a worst case scenario looks like. It's very valuable to see that, in my opinion. So let's get on into it and have some fun. So what we've got here are his 4 policies. A lot of information. I'm going to walk through it here line by line, and then we'll look at the loan scenario. So what we have, calendar year, right now, as of the day of this video, it is 2023. The husband's age is 48, the wife is 41. They've already funded their policies this year. The total amount they've paid in to date is just over $1.8 million. These are based on actual policies. The cash value to date is a little bit less than that, $1.8 million. And to put that into perspective, those 4 policies are between 2 and 5 years old. A couple of those policies, 2 specifically, are already cash positive. They've got a gain. Those were his first 2 policies he started closer to 5 years ago. The other 2 are 2 years old and 3 years old. So those are newer, which typically the break-even point, which is when our cash value exceeds our total payments, falls between 3 to 5 years if everything is set up correctly. The 3 to 5 year range depends on the company and product we pick. But as we look at this, additional funding, how much more did you want to pay in? About another $1 million. It's a little bit more than that. And again, he's in a position where he can do this. I'll add this. He can stop altogether right now and watch his cash value continue to compound. So he doesn't have to add those additional dollars. He's in a position where he can and he wants to. So total funding is brought up to about 2.8 over the next 2 years when he'll be 50 years old. There's his cash value. And these are the combined values, by the way, him and his wife. You've got the death benefit figures as well. You'll see a drop in the death benefit, a significant one over here. This has to do with a term insurance rider that's attached, which we can explain that and we do in other videos, or you can leave a comment below or email us. We can go through that. What that is just reducing the death benefit as low as we can to reduce costs when we're not paying anything in, which allows our cash value to grow at a faster rate, which is nice. So what we've got here, cash value growth, and this specifically is the yearly cash value growth. And then the cash value gain. This will look at your total payments and your cash value and show you what the difference is. So this year, he's in the red. The reason why is because he's paid in 1.8 million, 1.815, and he has 1.785. The difference is negative $30,000 because he has $30,000 less in cash value compared to what he's paid in. Does that make sense? Okay. The next year, we've got a gain because his total payments are 2.385. His total cash value is 2.407. He's got almost $22,000 more in cash value than what he's paid into the policy. That's why we have a gain there. And the cash value growth shows the total amount of money you received from the insurance company each year. So this is easiest to look at when I'm not paying anything in. Age 50, you're at 296. Age 51, you're at 3079. The growth that year was just under $120,000. So that displays the yearly cash value growth. So loans, that's what we said we're going to talk about. We're going to get right into that now. This is beneficial to see first because anytime you look at loans, I always like to see what the growth of the policy looks like first and then compare the two side by side. That helps me see exactly what the cost to borrow is. Just makes it easier. So what we've got here, we're going to start in 2025, where the total amount of money he's paid in is how much? $2.8 million. So that's when he's 50 years old. If we go back, age 50, you paid in 2.855. What we did was just remove a lot of columns because there's a lot of information here. We just want to focus on the important items. So we're starting in 2025 when he is 50 years old. what he's paid in, cash value, death benefit, cash value growth, how much it's growing by each year. And in 2025, we're assuming no loans are taken. In 2026, we are going to take some policy loans. So let's take a look here. 2026, if you don't borrow, there's your cash value, $3,079,000. When you take the first loan of how much? $370,000, what happens here? There's your cash value, drops. Death benefit does as well. We continue to borrow $370,000 per year. That's a lot of money we've loaned against the policy. However, we've got a lot of cash value compounding for us. So if you tally up those numbers, right, and we can do it this way, how much has he borrowed against the policy? $1.85 million. Let's assume he does this for his business or real estate. He's been heavily involved in real estate over the years, but he's taking these loans. We're assuming he's putting them into income producing assets, something that's going to generate a return. And then he's going to repay the loan, which is optional based on the amount he's borrowed. When we look at age 55, he's pulled out $1.85 million, but you still have $1.466 million net in cash value. What's still earning dividends and interest is this 3.637. So this cash value growth of $150,000 and change, I'm still getting that. We're very close to that in the entire amount. I say very close to that because one of these policies is direct recognition. You'll see what I mean at the end of this video. So he took those loans, $370 per year, and now we're going to repay those loans at $370 per year. Now he took it out for 5 years, 1, 2, 3, 4, 5. He pays it at 1, 2, 3, 4, 5, 6, 7. In the last year, $14,000 and change. He paid back more than what he took out. Why is that? The interest. So when he was taking loans, if we look up here, he's not paying any of the loan interest at all. He's just allowing it to compound. He begins to repay the loan principal and interest down here, and he's just applying a net of $370,000 per year. So he's paying back the interest, the accrued interest, and then each year, first applying money toward the interest, and the rest goes toward the principal, which is what you'll see every time you make a loan payment. I know that can be confusing. Here's the bottom line. Here's his cash value and death benefit. In fact, let's do it this way. That's better. So there's his cash value and death benefit compared to what we've got on the left. It's restored, right? It's a little bit higher, actually. And the reason why is because what he has are two policies with MassMutual, and then two policies with Guardian. And his Guardian policies are a little bit older. They have a fixed loan interest rate at 6%. And what that Guardian policy does, specifically the direct recognition option, is when you borrow, they still pay you dividends on any money in cash value and what's outstanding in loans. But the portion that's outstanding in loans receives a dividend of 6%, whereas the cash value receives a dividend of 5.75%. Point is the leveraged money is getting a dividend that's slightly higher, which is why when the loan is repaid, I see a slightly higher cash value and death benefit figure. Again, know that has a little bit to it. I do hope that made sense. If it did not, feel free to let us know in the comments below or shoot us an email, and we can definitely send a video that goes through recognition loans more thoroughly, or we can talk through it with you if you'd like to connect and see some actual policy loan demonstrations for a personal policy. So as always, I do hope that this helps. Have a great day, and we'll talk to you soon. Thanks again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.